Hello, everyone. I'm Varun Venkatraman, and I'm joined by my colleague, Andrew Tam. We're both equity analysts at CFRA Research based in London. Today, we're going to briefly cover some of our key observations from the second quarter 2021 results in the European market. Before we start, our discussion is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. So, Andrew, the last time we had a discussion after the first quarter results, we were expecting a flurry of good news. Did that play out in the stocks you research?
Hi, Varun. Yes, absolutely. Especially with the consumer space, where you've really seen a lot of pent-up demand, a cashed-up consumer as a result of all the government stimulus, and really the reopening of stores and movement in general across many countries. So when you combine that with what was a really weak second quarter last year at the height of the lockdowns, it's really meant that you saw some pretty favourable growth rates and recovery from those 2020 levels. But going back to what we said last quarter, so far the recovery has been patchy, and that's certainly what we continue to see. The autos and the luxury spaces, they've certainly shot the lights out during Q2 and really have bounced back a lot quicker than most. So names such as Louis Vuitton or Kering, who were the owners of the Gucci brand, they saw sales really accelerate to levels well above even pre-COVID levels. And then meanwhile, in the travel and tourism sectors, that remains pretty much in the doldrums still, with many international border restrictions still in place. So a broader recovery there is going to take a little longer and stretch well into 2022 and beyond. Geographically, there's been a lot of names that seen a pickup in their North American divisions, with restrictions seemingly being eased there a little bit earlier. So how are some of those trends translated for you in the industrial space, Varun?
Yeah, the recovery is positive on the overall for the industrial sector, but it's definitely not even. Firstly, there's a variance in recovery by geographic area. So at the start of the year, industrial businesses in areas which had recovered faster from COVID, mostly Asia Pacific, performed really well. And as the quarter progressed, North America started to perform really well. And now we're seeing that trend follow through in Europe and UK. So secondly, there's also variance at the industry level. We're seeing strong performance in some companies such as ABB, 3i Group, and Siemens, because they've been able to raise prices while volumes have grown as well. On the other hand, you have some companies like Vestas, which have struggled to sufficiently raise prices and are having more mediocre results in the second quarter. But part of this problem has also been due to raw material cost inflation and supply chain disruptions.
Yeah, absolutely. Many of the consumer names have really spoken to some of the same disruptions in cost inflation, really impacting things like their gross margins. So examples like Heineken or Coca-Cola Hellenic, they've all quoted to higher raw material costs, whether that be barley, hops or sugar, or even PET resin or aluminium, really impacting their second half margins and beyond. So the question there is, what can they do in terms of on the pricing lever? And really, ultimately, are their franchises strong enough to pass that on to consumers? Meanwhile, in the luxury space, where the price of the end product is pretty disconnected with the cost of the raw materials to begin with, that's probably been less of a concern. In fact, the likes of a Louis Vuitton or Hermès or Kering, they've all really been putting up prices throughout the pandemic. And it's certainly one of the key drivers of their quicker than expected bounce back from these earlier disruptions.
Yeah, so my key takeaway is that companies which have good pricing power, that is, they're able to pass on all the cost increases and even capture some of that margin, do really well. So for instance, the UK home builders. Now, house prices have run hard in the UK, much like everywhere else, as have the costs, right from timber through to labor. But home builders have been able to maintain or even improve their margins, which is one of the reasons we're positive on the sector. And you see some of this reflected in valuations, right? Where we're seeing a dispersion. The good businesses with strong capital structure, pricing power, and revenues from new and growing areas like robotics, automation, renewable energy, they tend to trade at a premium. And I think this is justified. It's still within a range that I would consider to be attractive for equity investors.
Yeah, no doubt. So arguably at this juncture, stock picking is probably a little bit more challenging than it was at the start of the year, given the ongoing rally that we've had. At the start of the year, you would have done pretty well buying into stocks, on the anticipation, of a reopening within that consumer space. But with the autos and the luxury space, both, up 20% or more year to date, a lot of that recovery has arguably already been priced in, particularly when you factor in some of the normalizing growth rates and some of the emerging headwinds that we've spoken about just now. At one end, you've got the likes of Hermès in the luxury space. They've sold through the pandemic pretty well, but equally, they've also got a share price at record highs. So whilst it's clearly a quality company, the 60 times FY22 consensus earnings leaves us pretty little room for error. At the other end of the spectrum, you've got stocks like Swedish Match. They've got a track record of historically delivering double-digit revenue and EPS growth, and really spitting out quite a lot of free cash flow, trading at just 19 times FY22 consensus earnings.
So in conclusion, the key drivers behind this recovery are still in place, and they are low interest rates, fiscal stimulus plans like the US infrastructure bill for $1 trillion, increased demand for many products from homes to clothes to cars, while the average consumer is in much better financial health than many had originally assumed. The second quarter has mostly continued with the record recovery theme, and we think there's more to come in the quarter ahead as well. But it's not uniform across every sector, and that's where we think stock-specific analysis makes a huge difference. Finding the specific winners and losers of each sector that can grow by more than just the recovery rate. We will leave it there for now. Thank you for your time, Andrew, and thank you all for taking the time to watch this video.